This week has been quite the roller coaster ride for stock market investors. Big ups, big downs, and a whole lot of worry. One measure of expected stock market volatility has spiked. The VIX, often referred to as Wall Street's fear index, surged to highs last seen in 2011. David Kaufman is president and CEO of Westcourt Capital, and he's here to offer nervous investors some advice. So, David, of course, you know, a lot of this ups and downs relates to your time horizon. How does the way you manage risk and your time horizon affect the way people are reacting?
That's an excellent question, because the concept of managing risk and your time horizon are linked. Because in the short term, which could mean, say, 3 to 5 years, it's all about managing risk is all about ensuring that you have enough income to live on if, say, you're retired and you're using your investments to create the money you're going to need to spend, and that you have enough liquidity in the event that you need to cash something in for one of those unexpected things that seems to happen more often than we would wish. And so in the short term, that's what you'd be focusing on from a risk management point of view. In the long run, say 5 to 20 years, it's more about protect and grow. So, you know, the first rule is protect my capital. The second rule is hopefully that you can have it grow at least as fast as inflation, so that the spending power of your capital is equal then, you know, to what it is now. And that comes down to more of a value proposition. So what that translates into, you know, on weeks like we've had to endure this week, is that the long-term investor, as long as they have the right securities that have the right kind of value, which comes back to old school fundamental analysis, should be able to kind of shrug it off and say, 10 years from now, 20 years from now, BCE or TELUS or whatever stock it is that you own is still going to be in business, they're still going to be making profits, and I'm still going to have value there. Whereas the short-term investor has to be very careful to ensure that they still have the kind of income that they need and that they don't have to sell into a falling market.
But when we look at a week like this, one of the questions that comes to mind is, you know, how different people are reacting, and the question being, you know, how are the amateurs reacting versus the professionals, the professional money managers? What is the separating them?
What really separates them, you know, before this week happens, everybody says, oh, I understand that risk is there and that we can have weeks, and as I said earlier, I can shrug it off. But, you know, when the rubber hits the road and we have a week like this, the pros and the amateurs are separated, because the pros say, what's on sale? How can I profit from this?
So they're buying. They're not panicking and running for the exits.
Right. The amateurs are saying, I think I'm going to be sick. How do I get out of this as fast as possible? So what happens is, the old adage of trying to buy low and sell high, is that if you're buying on the lows and then you're waiting to get full value, and when you think something is fully valued, you're selling, that's buying low and selling high. But if you're sort of following the crowd and saying, I haven't been in the market the last few years, I wish I were, so I'm going to get in, and then at the first sign of distress you sell, that's exactly the opposite. And, you know, it's sort of the old Buffett adage, which is, you know, be greedy when others are fearful and fearful when others are greedy. It's the easiest thing to say, but it's one of the hardest things to achieve, because who among us knows whether this week is just a little bit of a blip and it's a buying opportunity, or maybe it's the start of a major slide.
Now, what about people who have been borrowing, for example, to make their investments? How does the amount of leverage affect how people behave?
Well, you know, leverage is your best friend until it becomes your worst enemy, because it has the capability to significantly enhance your returns, but so too can it significantly enhance your losses. And the biggest issue with leverage is that at times of stress, like we're seeing right now, when you're underwater on an investment, when you might get, say, a margin call, is that you suddenly don't make your own decisions. The bank makes your decisions for you. And then you might be forced to sell at the worst possible moment. And you might think, but I'm right, if I could just hang on for a little bit longer, but they won't let you hang on. And so it comes back, you know, Keynes was famous for saying that the markets can be irrational longer than you can stay solvent. So being right isn't good enough. Having the capital and not having the leverage makes a major difference.
All right. Well, thanks so much, David. Most of us have left